All right, good morning and thank you for coming today. I'm Minnesota Management and Budget Commissioner Erin Campbell, and with me are State Economist Dr. Anthony D. Becker and State Budget Director Anna Mingy. Together we will present the November 2024 Budget and Economic Forecast. Before we begin, I want to thank Dr. Becker, who led the development of the economic forecast, his first since becoming State Economist after Dr. Laura Kalambakidis retired from the position last summer. I also want to thank his entire economic analysis team, as well as Anna Mingy and the budget services team, and all of the other staff at MMB and state agencies who provided the information necessary to prepare this forecast. Minnesota is among the states that show a 4-year window into our state's budget and economic outlook in our twice-yearly forecasts. This is a benefit to us. Only 19 other states do this. We analyze a large amount of data to develop our forecasts, which represent the best financial projections that we can provide based on information available when we prepare them. In this forecast, we continue to refine our projections for the budget years FY 26-27, which will provide the essential information to policymakers who will use it to develop the next state biennial budget. We are also going to present estimates for FY 28-29 for the first time, so policymakers are also going to have a view into what lies ahead and can use that for their consideration in their decision making. What you'll see in this forecast is that, like many other states, Minnesota is facing some significant economic and financial headwinds. We'll talk about some specific factors in the coming slides, but one major economic underpinning that states have in common is that in recent years, federal economic stimulus dollars aimed at offsetting some of the financial impacts of the pandemic have boosted personal and business spending and related tax revenues. As the pandemic has ebbed and stimulus spending has fallen, states across the nation, including Minnesota, began seeing revenues return closer to pre-pandemic levels. Move to the next slide. In this forecast, we expect an available balance in fiscal years 26-27 of $616 million. That is $1.1 billion less than we had projected at the end of the 2024 legislative session. Spending growth continues to exceed revenues throughout the budget horizon, and this structural imbalance continues into the planning years, creating a projected deficit in the FY 28-29 biennium. When you look at the revenue forecast, we project lower than previously expected revenues from income and sales taxes, which are Minnesota's largest tax categories. And as I mentioned, state spending is expected to increase, led by spending for long-term care services, for people with disabilities, as well as special education services. It's worth mentioning that this forecast does not take into account the coming changes in federal leadership. We don't know yet exactly how and to what extent federal policies might shift or what impact those shifts would have on Minnesota's state budget picture. We may know more about that in February. Lastly, statutorily required allocations to the budget reserve leave us with the highest balance in the reserve to date. This will help us weather critical, unexpected events that might occur during the forecast period. Healthy reserves are, of course, an important part of Minnesota's commitment to financial planning. This slide shows the FY 26-27 budgetary balance for this forecast in the middle column compared to end of session estimates on the left, and the column furthest to the right shows the difference between the two. The projected balance at the end of fiscal years 26-27 appears under the lowest horizontal line. As you can see, we now forecast a positive balance of $616 million for fiscal years 26-27, and that's after the statutory transfer of $264 million to the budget reserve. At the bottom of the slide, you can see what the balance would be if we did not include discretionary inflation in the totals. Discretionary inflation consists of the estimated cost to maintain the current service levels. It's important to note, however, that the 2025 legislature would have to appropriate those funds, as these increased levels of spending do not occur automatically under current law. If inflation were not added to those line items, we would expect to end fiscal years 26-27 with a balance of $1.5 billion instead of $616 million. Any unspent balance from FY 26-27 rolls over into the next budget period, being FY 28-29, meaning new spending in this upcoming legislative session would reduce the amount available to soften the projected deficit in FY 28-29. This next slide is designed to help visualize what we're seeing happen over the forecast horizon. So let's start with the column in the dark blue on the left of the slide. This shows the $3.8 billion projected balance from FY 24-25 that we expect will carry over into the next biennium. That becomes a starting balance in FY 26-27. Moving to the next set of blue columns, our starting balance of $3.8 billion in FY 26-27 is reduced by the size of our structural balance, or the amount that spending exceeds revenues. That reduces the balance by $2.2 billion. When you include an estimated $926 million in spending for discretionary inflation, we're left with a balance of $616 million that is available in FY 26-27. If left unspent, this balance would be available to carry forward into FY 28-29. Let's look at what happens in the yellow columns on the right, representing fiscal years 28-29. Keep in mind that we're starting that biennium with $616 million of carry forward from FY 26-27 if it's not spent this legislative session. And just to state the obvious, this is clearly a lot less than the $3.8 billion that we anticipate beginning this coming biennium with. So our financial picture is more constrained from the very beginning of FY 28-29. During fiscal years 28 and 29, we expect spending to exceed revenues by $3.5 billion. If we were to take out all the inflation, both from FY 26-27 and 28-29, we would see a projected deficit of about $2 billion. But when you add in that inflation, we'd be left with a deficit of $5.1 billion. Constitutionally and statutorily, Minnesota is required to enact a balanced budget for the coming biennium, or the biennium that we're planning for, and that, of course, is FY 26-27, where we do estimate the small surplus. But as you can see, spending decisions that are made this legislative session will have impacts on the planning years, and we are anticipating some challenges in those years. It will be especially important for policymakers to take the long view when making budget decisions this year. With that overview, I'd like to invite our state economist, Dr. Tony Becker, to the podium to cover our economic and revenue forecast.
Thank you, Commissioner Campbell. I'm Anthony Becker, the Minnesota State economist. I'm going to start with a review of the U.S. economic outlook and significant changes since February, move next to Minnesota's economy, and then finally turn to the details of our new revenue forecast. Since Minnesota's budget and economic forecast was last prepared in February of this year, the outlook for the U.S. economic growth has improved somewhat. In the near term, robust growth in real gross domestic product in 2024, combined with easing financial conditions, has prompted S&P Global Market Intelligence to raise their GDP forecast for 2024 through 2026. However, in the longer term, there are indications of a cooling labor market, and the forecast is for real GDP growth to slow over time. In the first chart, we show the S&P forecast for annual growth in real GDP. The light bars show the February forecast, and the dark bars show the history and the current forecast. The Bureau of Economic Analysis now estimates that real GDP grew by an unexpectedly strong 2.8% annual rate in the third quarter of 2024, and S&P expects some of that momentum to carry into 2025. As a result, S&P now expects real GDP to grow 0.3 percentage points faster than they did in their February forecast, with average annual real GDP growth over the period 2025 through 2029 also revised upward by an average of 0.2 percentage point per year. The U.S. inflation rate, as measured by both the Consumer Price Index and the Federal Reserve's preferred measure, the Core Personal Consumption Expenditure Index, continues to fall. Inflation has already decreased significantly without the economy experiencing aggregate job losses. The current baseline forecast depends on a continuation of the Federal Reserve's current policies. S&P expects the Federal Reserve will lower the federal funds rate target by another 25 basis points this year. Moving forward, S&P expects the Fed to lower the federal funds rate target gradually until it reaches a range of 2.5 to 2.75% in early 2026. This monetary easing is conditional on inflation approaching the Federal Reserve's target rate and on a further cooling of labor markets. If inflation persists above the forecasted levels, the Federal Reserve may act less aggressively in lowering interest rates than assumed in our baseline forecast. Higher interest rates would tend to reduce private investment and some forms of consumer spending, dampening GDP growth. The next chart illustrates the nominal dollar value of consumer spending on goods and services. The nominal values do not correct for inflation. That is, they include the effects of price changes. The solid lines show the history and the dotted lines show the November forecast. The light blue line illustrates nominal consumer spending on goods, while the dark blue line shows consumer spending on services. Both series have been indexed to the first quarter of 2020. That is, they were scaled to both equal 100 in the first quarter of 2020 to make comparisons of growth in each measure since 2020 more apparent. For many years, consumers have been allocating increasingly smaller portions of their budgets to goods and increasingly larger portions of their budgets to services, including housing and healthcare services. From 2020 to 2022, this trend was temporarily interrupted by the pandemic, as higher goods prices, combined with increased quantities of goods purchased, raised total goods spending, while at the same time consumers' services spending was constrained. S&P expects the share of consumer spending on goods to decline further through the forecast period. They also expect the share of spending on housing and healthcare services to reach record highs in 2026. The BEA's updates to the National Economic Accounts announced in September 2024 included substantial revisions to the historical data for 2019 through first quarter of 2024. We now know that consumer spending on durable goods was not as strong as the BEA previously estimated. The November forecast reflects both the lower history and a lower near-term forecast for consumer spending on durable goods. S&P expects consumer spending on durable goods to increase 4.7% in 2024, that's in nominal dollars, and 5.6% in 2025. The shift in spending from goods to services has implications for the state's sales tax revenues, which I will mention again when we look at the sales tax revenue forecast. Moving to Minnesota's labor market, this chart shows the official unemployment rates for Minnesota with the dark line and the U.S. with the light blue line. The state's labor market has cooled somewhat from the record low unemployment rates and record high job vacancy rates that we experienced over the past 3 years. The unemployment rate in Minnesota remains low at 3.4%, 0.7 percentage points below the U.S. rate. However, since April, Minnesota's unemployment rate has increased from 2.7% to 3.4%. We will be tracking the state's unemployment rate and labor market conditions closely. Although the rate has increased in recent months, this is still a low unemployment rate compared to our history, and Minnesota still has a tight labor market with 1.8 job openings available for every unemployed worker in the state. In its forecast, S&P expects the national unemployment rate to rise to a high of 4.6% in late 2027. This is the rate they estimate represents full employment for the U.S. economy. Given S&P's outlook, it's reasonable to expect Minnesota's unemployment rate to rise slightly over this period too. At 67.7%, Minnesota's labor force participation rate is 5 points higher than the national rate and is fifth among U.S. states. The high labor force participation rate and relatively low unemployment rate means that growth of Minnesota's labor force is constrained. Domestic or international migration of working-age people into the state could ease that constraint. A crucial variable influencing Minnesota's individual income tax liability is total wage and salary income. As employers work harder to fill open positions and businesses make investments in technologies that enhance productivity, wage and salary income per worker, or average wage income, is expected to continue to increase. In February, we forecasted that total wage income, the sum of all wages distributed, would increase 5% in 2024. But we now expect wages to grow 4.5% in 2024 and slow to a stable growth rate of 3.9% per year on average for the years 2025 to 2027. The demographic reality of Minnesota's baby boomers aging out of the workforce continues to limit employers' ability to add jobs. Slow employment growth together with stable wage and salary growth means that average wage growth per worker, rather than growth in the number of workers, is expected to be the primary driver of growth in total wage income through our forecast horizon. I would like to take some time to highlight some of the risks to this forecast, both upside and downside. The current baseline forecast assumes that the growth in GDP slows, the growth rate slows, the U.S. unemployment rate rises slightly, and inflation falls to the Fed's target range. S&P assumes the Fed continues monetary easing and that the federal funds rate reaches the range of 2.5 to 2.75% in early 2026. We see several possible downside risks to the forecast. First, if inflation rises unexpectedly, the Fed may act less aggressively in lowering interest rates than assumed in the baseline forecast. Higher interest rates would tend to reduce private investment and some forms of consumer spending, reducing GDP growth. International conflicts, for example, in the Middle East or between Ukraine and Russia, pose a risk to the inflation forecast through potentially higher shipping costs, commodity prices, and energy costs. Additionally, the possible effects of proposed tariffs and immigration policies could put upward pressure on prices, threatening the forecasted monetary policy path. Finally, high federal deficits and national debt could weigh negatively on economic growth in the long term. There are also potential upside risks. Fiscal stimulus, perhaps due to changes in tax rates or tax credits, could support more robust consumer spending or business investment than is currently expected. The prospect of lower energy prices is another possible upside risk. Higher productivity growth, perhaps from emerging technologies such as AI, could also boost economic growth, even if additions to the labor force are modest. Inflation continuing at stable and predictable levels and moderation of interest rates could lead to higher private investment and consumption spending. With 31 months remaining until the end of the 26-27 biennium, even small changes in the assumed rates of growth in important income sources, including capital gains realizations and in corporate and partnership profits, can generate large changes in the revenue outlook for this biennium. Moreover, the difficulty of projecting long-range economic conditions and taxpayer responses to law changes warrants caution when using forecasts for the fiscal year 28-29 biennium. Let's now turn to the revenue forecast. The first two columns show our February forecast, adjusted for law changes labeled end of session, and our current November forecast, both for the fiscal year 26-27 biennium. Compared to February, we are now forecasting that general revenues will be $992 million, or 1.5% lower than were forecasted in February. Our forecasts for corporate franchise tax revenues and other tax revenues are higher, and our forecasts for individual income tax and general sales tax revenues are lower. We now expect individual income tax receipts to be $830 million less than the prior forecast. We also expect that income tax liability for tax year 2023, which is the base year for this forecast, will be lower than we had estimated in February, lowering the starting point for the income tax forecast. On its own, a lower estimate of base year tax liability directly decreases the forecast of future liabilities. The principal factors contributing to this decrease in the income tax forecast include a lower forecast for capital gains realizations, a reduced forecast for wage growth that I showed earlier, and other technical changes in our models and assumptions. The sales tax revenue is now forecasted to be $541 million less than our prior estimate. This is due to lower than expected net sales tax receipts in 6 of the past 7 months, and a lower forecast for taxable sales consistent with the shift in consumer spending away from goods and towards services that we discussed earlier. For the corporate tax, a higher base from higher receipts to date in the fiscal year is offset slightly by a lower forecast for corporate profits. The net effect is a rise in the current corporate tax forecast by $90 million over our February forecast. All other revenue is expected to be $290 million more than we expected in February, and this is largely due to a higher forecast for investment income, which has come in above forecast in recent months. I'll now turn this briefing over to State Budget Director Anna Minghey.
Thanks, Dr. Becker, and welcome to the team. I'm Anna Minghey, State Budget Director here at MMB, and I'm going to discuss what's happening on the spending side of the ledger. This slide outlines anticipated changes in general fund spending for the upcoming budget biennium, fiscal years 2026 and 2027. In total, we project the general fund spending will reach $66.989 billion, $572 million more than our previous estimates, a change of less than 1%. While this table doesn't include estimates for the current biennium, 2024 and 2025, I think it's important to note that we are projecting lower spending in 26-27 than in the current biennium by over $3 billion as a result of significant one-time appropriations in 24 and 25. So let me walk you through the table to describe what's causing this change. The first line, E12 education, is our largest area of general fund spending. We project it will reach $25.4 billion in the upcoming biennium. This is an increase of $202 million, or about 0.8% from previous estimates. This increase is primarily a result of higher costs for special education, where we've seen preliminary data suggest that 2024 special ed costs grew by 9% over the previous year, compared to more typical increases of around 4 to 6%. The next line, Health and Human Services spending, is projected to reach $23.8 billion next biennium, a $388 million increase from previous estimates. Long-term care services for people with disabilities are projected to cost more than we previously expected. While some of this is due to higher enrollment, the larger driver here is higher average costs, which I'll discuss more in a later slide. On the next line, property tax aids and credits spending is $88 million above previous estimates, driven primarily by homestead credits being higher than previously expected. Property taxes are expected to grow faster than household incomes, which contributes to an increase in the refunds that the state is anticipating to pay. Spending for debt service on state-issued bonds is $129 million, or 9.5% lower than previous estimates. This is largely the result of the no bonding bill being enacted last session and a smaller than expected bond sale over this summer. Changes to all other areas of the state budget are relatively small, combined $59 million below previous estimates. So you'll see in italics, the forecast also includes an estimate of discretionary inflation for biennia without an enacted budget. So in this case, it's 26-27 and 28-29. We estimate this cost will be $926 million for the upcoming biennium, an increase of $81 million from previous estimates due to a slight increase in forecast CPI. This number is meant to be a guide for policymakers about the cost of funding current services in the wake of rising prices. We refer to the figure as discretionary inflation because it's only calculated for programs where funding formulas don't already include factors to adjust for growing prices. About 60% of the general fund is actually excluded from this calculation because inflation is already accounted for in other lines of the forecast. It's important to emphasize that this money doesn't automatically flow to programs. It must be allocated and appropriated by the legislature. Policymakers have the choice, the discretion, to use this money to address inflationary pressures. They could spend it on something else or could leave it unspent, which would result in savings to the general fund bottom line and an improvement to the bottom line balance. So all of those changes combined add up to the total change of $572 million that you'll see on the bottom line of the table. But let's look ahead to the next biennium, 2028 and 2029. This is the first forecast to give us a real look into projected spending in the 28-29 biennium. Spending is projected to grow from $67 billion to $73.4 billion. Of that growth, $1.3 billion is a result of accounting for 2 additional years of discretionary inflation. And as I just described, the discretionary inflation does not represent an actual obligation to the state budget, so I want to focus on our base spending before inflation, where spending is growing about $5.1 billion. Of that, $3.1 billion is in Health and Human Services, and $1.6 is in education. Education spending has historically been the largest area of the general fund budget. However, in this forecast, we project HHS and education to become roughly equal proportions of the general fund in the 28-29 biennium, both constituting about 38% of general fund spending. By 2029, if you look at an annual basis, the forecast projects HHS will actually surpass education as the largest area of general fund spending. So let's look a little deeper into each of these areas, starting with education. As you saw on that previous slide, education is projected to grow about $1.6 billion. Now, this chart shows education spending starting all the way back to 2014-15 into our planning years of 2028 and 2029. The chart is broken into 3 main program areas: Gen Ed, the largest area of education spending, special education, and then all other programs. In general education, the forecast reflects growth driven by inflationary increases of 2 to 3% per year on the per pupil allowance. But some of that is dampened by a decline in the projected pupil population due to declining birth rates. But the largest contributor to growth, despite not being the largest program, is actually special education. And here we're seeing higher costs due to more students being served and higher costs. The number of students receiving special ed services is growing from 148,000 in 2019 to 165,000 in 2024. And we project it will reach almost 200,000 students by 2029. In addition, state special ed is a cost-based program. That means the state reimburses schools for a portion of the costs that they incur to deliver these services, which means the program is sensitive to rising prices. The 2 most important costs are compensation and transportation. In recent years, both of those costs have grown more quickly, which has contributed to upward revisions in the forecast, as well as higher growth into the future. So now we'll move on and discuss a key driver in Health and Human Services. As I mentioned before, Health and Human Services is projected to grow about $3 billion from the budget years into the planning estimates. And almost half of this growth is in waivers and home care, serving people who need long-term supports but want to live in their community. Some of the fastest growing services are programs serving people with disabilities, often referred to as disability waivers. Over the last 10 years, we have seen significant increases in both the number of people accessing services and the average cost per person. What this chart shows you, and the blue bars represent average monthly recipients on disability waivers, and the green line shows the average per person monthly cost. Prior to 2015, there were statutory enrollment caps that restricted the number of people who could access these programs. Since those limits were lifted, enrollment in disability waivers has grown more quickly than we expected, by over 7% per year on average. The forecast assumes it will continue to grow, but at a slightly lower rate. In addition, as you can see on this slide, the average cost for these services has also grown significantly over time. Average costs have grown by about 4% per year, and the forecast assumes the growth will accelerate to closer to 6% per year from 2024 to 2029. One key driver in this program is periodic inflationary increases, where rates increase every 2 to 3 years under state law. One example of this is that in 2026, these rates will go up by on average 12% to account for the inflation that occurred between 2021 and 2023. However, these increases only explain a portion of the trends we're seeing here. One trend the DHS has observed is an increase in the use of exceptions to the standard statewide rate framework. In many instances, a county will request an exception when they feel a person's needs can't be met by the statewide framework. On average, payments under these exceptions are significantly higher than they would be under the statewide framework, and the increased use of these exceptions is one of several other factors driving higher costs for these services. Clearly, long-term care funding is an incredibly complex system. The combination of more services, higher cost per services, inflationary increases, and higher enrollment have contributed to significant cost growth over time. With that, I'll turn it back to Commissioner Campbell, who will review our long-term outlook.
All right, thank you, Anna. This slide shows the long-term budget outlook. It compares our forecast revenues against our projected spending for the coming biennium as well as the next, and that's without the impact of any unspent balances or transfers to our budget reserve. And as a reminder, this view is what we call our structural balance. While revenue is still projected to grow, we are seeing that in both biennia, projected spending is set to outpace forecast revenues. In fiscal years 26-27, projected spending is nearly $67 billion compared to $63.8 billion in projected revenues, leaving a structural imbalance of $3.1 billion. Then in fiscal years 28-29, total spending is projected to be $73.3 billion compared to $67.6 billion in revenues, creating a $5.8 billion gap. If you look to the far right, you see a column that illustrates that we do expect revenues to continue to grow by 2.8% annually, but you'll also see that we project spending, including inflation, to grow at a higher rate of 4.7%. And as you can see on the last line on the slide, the structural imbalance would be less in both biennia if we did not include the discretionary inflation. One of Minnesota's budgeting strengths is our commitment to healthy reserves to help weather unforeseen circumstances that can occur after a biennial budget has been enacted. Maintaining adequate reserves is important not only to prepare for the unexpected, but also to demonstrate to our rating agencies that Minnesota has strong financial management tools at the ready. Reserves are one factor rating agencies have used in awarding Minnesota's AAA credit ratings from all three agencies, which is amongst the best in the country. Maintaining Minnesota's strong credit ratings lowers the cost of borrowing. This chart illustrates the growth in our general fund budget reserve over the past 15 years. Since 2014, Minnesota has had a budget reserve target based on an annual analysis of revenue volatility. State law directs 33% of the November forecast balance to the reserve until the target is met. Our current target is 5.2% of general fund revenues in the current biennium. As you can see, our total cash flow and reserve amounts combined were about $1 billion in 2014. And right now, they stand at slightly over $3.5 billion, which does include the $264 million added to the reserve in this forecast to meet the statutory target under Minnesota's nation-leading budget reserve policy. Before we close out, we wanted to share this particular slide one more time as a reminder of the financial picture in this upcoming biennium and the planning years. For the last year, you have heard us projecting a structural imbalance in FY 26-27. You see that depicted in the blue bars on the left, where we also project a small surplus of $660 million. What we're seeing for the first time in this forecast is that the structural imbalance is expected to grow in fiscal years 28-29, resulting in a projected deficit in that biennium. Clearly, a deficit of this magnitude would prove to be a considerable challenge for future lawmakers. But here in Minnesota, we have the benefit of forecasting over a 4-year window, giving us access to an incredibly valuable resource, which is time. Not only do we have advance notice to spot a problem on the horizon, we also have ample time to take action and change the trajectory. We hope the November forecast provides policymakers the knowledge and opportunity to plan ahead and make thoughtful and deliberate budget and policy decisions that maintain our state's strong financial footing. With that, we'd be happy to answer any questions.
Commissioner, you used the word deficit this time. We all had a debate about that last time. So officially, it is deficit. And talk to us a little bit more about how concerned you are about that actual projected deficit now.
Yep. And maybe just to add a little bit more color, as you recall, last time we had projected positive balances in both of the biennia in the forecast window. This time we do actually see a projected deficit in 28-29, which is why we're using that language. I mean, clearly that we have to realign the budget to make sure that spending and revenues match. And so, I think that the fact that we have plenty of time to do that, and we have a lot of information to do that well, I think that it's good to have information to inform our decision-making, but I am confident that we can address the problem.
Commissioner, do you see any scenario whereby we could go into a deficit situation in 26-27 or in all the potential problems in 28-29? I understand this involves risk factors, but can you give us an assessment of that?
Yeah, and Anna can speak to this in terms of spending increases. I think that we generally anticipate that, we'll catch a lot of those spending increases in the November forecast. We will have the February forecast, and those will be better numbers that legislators can use to help set the budget. And though there is some risk, but the fact that we have $616 million, I mean, that's still considerable resources on the bottom line, especially if we look back historically at past forecasts and what's been available.
Did you know this was coming when you took the job? Second question is, I'm trying to understand the difference between, I would think if you're adding to GDP growth as the national forecast would show,
Right.
that should reflect better numbers on the other side. And I know that you then showed us the sales tax issues and the income tax issues because of income growth. But when I saw that you were adding to GDP, I thought that should make the numbers look better than this.
So first off, I have no buyer's remorse. Okay, so yes, GDP growth is up a little bit, but that's only one part of the picture. The other part is that there were some substantial revisions in a number of other areas that were announced in September, and that has caused us to change several of our other components of forecast. So, for example, I mentioned that durable goods are down from where we thought they were back in February, and that the forecast for those going forward is lower. The other thing is that we're dealing with some specialized data for Minnesota's economy, and our labor force growth might not be as high as the growth of the labor force in the country as a whole. And what this means is that we might not be able to expect our total wage and salary number to rise as fast as it might in the rest of the country. And so GDP growth is good, but it's only a part of the story.
Corporate profits as soaring.
Would I address corporate profits as soaring? Corporate profits, I can tell you, have exceeded the professional forecasters' expectations quite frequently. That is a potential upside risk to our forecast. If that pattern continues, we could see more corporate franchise tax revenue than we are expecting. But right now, we're going with the forecast that S&P has for that.
What about income tax? It's down slightly. Do we know why? Are people making less? I have enough people moved. What's behind the income tax slide?
What's behind the downward revision in our forecast of the income tax is, and I want to make sure I say things properly, so I'm going to refer to my notes, is that the tax year 2023 liability has come in now. Since February, there was an estimate of that. Now we have almost a complete picture of tax year 2023. There are still some returns left to be processed that will almost all be processed by the end of January. So for our February forecast, we should have a very solid idea. But that tax year 2023 liability has come in lower than we were expecting in February, and that caused us to then have a lower base to project forward from.
Why? Are people making less? Are high income earners leaving? Do we have a sense why those numbers appear to be down?
I think, well, partly, I think 2021, 2022 were unusual years. There were some periods of very high capital gains realizations, and we're not seeing that same level again. So that we've got really the idea that, that more recent history was exceptional, and I think now we're going back down to where we were pre-pandemic.
That inflation piece is a pretty big part of the structural imbalance. Can you speak a little bit about how that's projected, especially with an incoming president whose policies, like tariffs, could cause that inflation to grow?
For discretionary inflation, we are using CPI. And so relative to, in terms of the impact of a new president's policies, we don't know what the impact of that is at this point. We don't know exactly what the policies are. We don't know what the impact is on the state of Minnesota. And so at this point, I think it's just too early to say.
Do you expect that to be pretty volatile?
Do you expect that?
So we are using the forecasts that we have for consumer price index going forward. And let me also say that our forecasters, S&P or SPGMI, are consistent with all the other major forecasting houses out there in the various surveys. Now, as for whether some of the proposed policies or discussed policies are going to be inflationary, at this point, we really don't know because we don't know exactly what those policies are. We don't know if tariffs will be implemented, how big they'll be, and what the effects are going to be. So I think it remains to be seen. I would say that we should have a better idea by the time of our February forecast, though.
Tariffs, are we already seeing an impact, though? There are businesses that are preparing and making changes and increasing prices in anticipation of tariffs. So isn't some of that already a reality, the impact?
Well, we won't know about November, December numbers for a little while. Certainly, people in the economy do anticipate changes, and they behave accordingly, and sometimes they can create situations which sort of, if people expect inflation, they can cause inflation through their behavior. But, I think until we see the numbers on what's happening, we just have to take a wait-and-see approach.
Dr. Becker, you mentioned downside as a possibility from Ukraine and the Middle East situation. I realize this has happened more recently, but do you have any thoughts on South Korea, the situation there? Might that be an additional downside risk?
I really don't. I just know that the situation there resolved itself very quickly. I guess it's another one of those wait-and-see moments.